Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into LyondellBasell, ticker LYB, and peeling back the layers on a massive, high-stakes corporate restructuring. And this has made the stock, with its, truly astonishing yield, basically impossible for income investors and turnaround specialists to ignore.
That yield really is the elephant in the room. It's just huge.
It is.
When you see a company of this size, we're talking about a global giant in petrochemicals and polymers offering a dividend yield that sources are putting at right around 12 to 13%, you are instantly looking at a binary investment.
Right. It's either a huge win or a total disaster. There's no middle ground there.
Exactly. The core question you have to ask is this management team executing a brilliant financial maneuver, transforming the business into a leaner, cycle-proof powerhouse right at the bottom of the petrochemical cycle? Right. Or are we witnessing the textbook definition of a classic value trap, where that high yield is actually a warning siren just screaming that a dividend cut is imminent?
And what's drawing all the scrutiny is just how aggressively they've responded to this brutal global industry downturn. They haven't just, pulled back a little.
No. They've launched a full-scale assault on their own portfolio.
They really have.
Absolutely. Our formal thesis here is that LyondellBasell is currently undergoing what we can only describe as radical portfolio surgery.
Radical portfolio surgery. That's a strong phrase.
It is. This is not just optimization. This is a comprehensive, multi-year operation designed specifically to generate internal cash, what they're calling self-help liquidity.
Self-help liquidity.
And it's all to bridge the gap until the global market is projected to recover, which, most people think is probably 2026 or 2027.
So the core conflict, the big bet.
The high-stakes bet they're making is whether they can execute these aggressive asset sales and relentless cost-cutting fast enough to maintain that massive 12% dividend yield, all while the entire global petrochemical market is just suffering from deep structural overcapacity.
Okay, let's unpack this, because the strategy really starts with the surgical removal of these non-core assets. LYB is fundamentally implementing what they call a shrink-to-strength model.
That's right. They're focusing only on the regions where they have a sustainable structural cost advantage.
And the first major limb they amputated was something many analysts, including some in the sources we looked at, were kind of surprised to learn they still even owned their legacy Houston refinery.
This exit was a really decisive move. It signaled a permanent retreat from the volatile, low-margin fossil fuel refining business.
So they can focus on what they're actually good at.
Exactly. To concentrate exclusively on higher-value petrochemicals and their new circular solutions platform, LYB officially ceased business operations at the Houston refinery in February 2025 and moved it formally into discontinued operations.
And the scale of this closure was just staggering, wasn't it? This wasn't some minor facility they were shutting down.
Not at all. We're talking about taking 263,000 barrels per day of refining capacity offline.
263,000. To put that into real-world terms, one of our sources actually calculated that this is equivalent to about 11 million gallons of gasoline just vanishing daily from the Gulf Coast supply chain.
It's documented as one of the largest U.S. refinery closures in recent memory. It really demonstrates a commitment to change that, frankly, investors were demanding.
A necessary statement, then.
It was a necessary and a huge statement. And from the perspective of LYB's self-help thesis, the financial benefit of this closure was immediate. And powerful.
Okay, how so?
Well, first, they just stopped a major capital drain. Refining operations, especially older ones like this, they require substantial, continuous, sustaining capital just to keep them running.
Sustaining capital. So the money you have to spend just to stand still.
Exactly. To keep them running safely, efficiently, and, in compliance with ever-increasing regulatory standards. By closing it, they removed a significant recurring liability that just sucked up cash every single quarter.
And second, this provided an immediate, and I think for many, an unexpected cash boost that was linked purely to accounting rules.
That's the other piece. They liquidated all the low-cost crude oil and product inventory associated with the refinery exit, which under some very specific accounting methods gave them a substantial injection of cash.
Right. This is that LIFO benefit I read about.
That's the one. They generated an immediate, one-time $196 million LIFO, last in, first out benefit during the first 9 months of 2025.
Wait, explain that LIFO benefit, $196 million. How exactly does an inventory accounting change suddenly turn into usable cash? It sounds a little like financial magic.
It's not magic, but it is aggressive capital management. So when the refinery was running, a significant amount of cash was tied up in the form of raw crude oil and finished products just sitting in tanks and pipes. That's inventory.
Okay.
This inventory was valued on their balance sheet at its historical, very low cost LIFO value. When they stopped operations, they sold all of that physical inventory at current, much higher market prices.
Yeah.
So that $196 million is the difference between the low book value and the higher cash value they actually got. It wasn't operating profit in the traditional sense. It was just unlocking capital that was previously inert, just sitting on the balance sheet.
So LYB effectively replaced a volatile long-term operational liability, the cost of maintaining that refinery, with a nearly $200 million immediate cash infusion. And that cash then can be immediately reallocated.
Precisely. It went straight into the war chest, ready to be deployed to fund the dividend and invest in their, more resilient, forward-looking technologies like MoReTec, which I'm sure we'll get to later.
Right.
The strategic shift is unambiguous. Moving resources from maintaining volatile crude oil operations to concentrating capital on resilient, high-margin, forward-looking petrochemical operations.
Okay, so the Houston refinery was the first step of this portfolio surgery. The second, and you could argue it's even more critical, is focused entirely on Europe.
Yes, Europe, where they are battling against high structural energy costs and, frankly, a lot of regulatory burdens. This is the planned European asset divestiture.
And it's necessary specifically to stop the cash burn from their highest cost operations, right?
It is the execution risk that really dictates the entire trajectory for the next year. LYB signed an agreement to sell 4 major high-cost European olefins and polyolefins assets.
Which ones are those?
The sites in Berre-le-Tang in France, Münster in Germany, Carrington in the UK, and Tarragona in Spain. These are, aging assets that have been operating at a chronic disadvantage for years.
And the timeline for this transaction is really critical. It's expected to close in the first half of 2026. Given the state of the European chemical industry, what's the financial goal here? Because some analysts are suggesting they are essentially paying someone to take these assets off their hands.
In a sense, they are. They are paying for a permanent divorce from a significant liability. The financial goal here isn't revenue, it's the immediate and permanent elimination of cost drag.
So it's all about stopping the bleeding.
100%. This sale is designed to eliminate a massive $300 million in annual fixed costs. And think about what those fixed costs cover. High labor costs in Western Europe, onerous maintenance and regulatory compliance, and most critically, high utility and energy overheads.
Right, because European chemical producers are disproportionately reliant on those expensive Russian replacement gas sources.
And the operational context just reinforces why this capacity had to be shed immediately. The data we saw shows these European O&P assets have been running at roughly 60% utilization.
60%.
60%. Meanwhile, their North American segment is targeting utilization rates in the high 80s or 90s. They weren't just low margin, they were a systemic drag on the entire corporate profitability.
That's why they're willing to pay to get the deal done.
That's exactly why. To fully capitalize the disposal group and stop the bleeding, LYB anticipates making a cash contribution of approximately $300 million to the buyer before closing.
$300 million. And that's not all, is it?
On top of that, you have complex separation costs, things like moving IT systems, environmental assessments, internal financial restructuring, that could easily add another $100 to $150 million.
Wait a minute. If they're paying up to $450 million in total cash just to offload assets that presumably generated revenue, doesn't that raise a massive red flag? I mean, if these plants are so toxic that they have to incentivize someone to take them, doesn't that suggest the underlying valuation of all their aging global assets might be overstated?
That's a crucial point, and it's the skeptical lens we absolutely need to maintain. It signals a distress sale. There's no doubt about it. Okay.
However, management argues that the alternative, holding on to these assets and being responsible for hundreds of millions in sustaining capital and operating losses indefinitely, is financially much worse.
So it's the lesser of two evils?
They view that $300 million contribution as a painful but necessary investment to achieve the $300 million annual cost savings and permanently remove the headache. It's a net present value calculation. The long-term cost avoidance justifies the short-term pain. This is an investment to permanently stop the bleeding.
This radical restructuring ultimately takes us back to the foundational competitive advantage of LYB, which is their geographic arbitrage. If they're shedding Europe and betting the house on North America, they must have a durable moat based on cheap raw materials that their global competitors simply cannot replicate.
They do, and it is the single most important variable in their success. The advantage created by the oil-to-gas ratio, which defines the cost of feedstock globally.
Right. LYB's entire North American operation is built around highly efficient, flexible crackers that primarily use cheap natural gas liquids or NGLs, specifically ethane. Ethane constitutes 75% to 80% of their feedstock in the region.
And this is where that structural global cost difference kicks in.
Exactly. Global competitors, especially those remaining in high-cost Europe and many in Asia, they primarily rely on expensive crude oil-based naphtha to produce their ethylene and propylene.
And naphtha is linked to the price of oil.
Structurally linked to the price of crude oil, which is currently much, much higher than the price of U.S. natural gas derivatives like ethane.
So LYB's entire shrink-to-strength model really relies on this one differential.
Yeah.
What does that cost gap look like in measurable terms?
This difference gives LYB a durable structural cost advantage that ranges between 30% and 40% over those naphtha-based producers.
30 to 40%. That's huge.
It's a massive moat. It means that LYB's North American segment can maintain positive margins even when global pricing collapses to depths that would bankrupt their international competitors. This is the rationale behind concentrating all future capital and operational focus in these advantaged regions. They are shedding the structural liabilities to maximize their structural assets.
So it's a clear strategy. Use the profits from the cheap, high-utilization North American plants to subsidize the cash needs of the corporation while they execute this painful, costly divestiture of the expensive, low-utilization European sites.
That's the summary in a nutshell. They are fundamentally changing their portfolio composition to elevate their structural profitability, which is a necessary defensive move because the global industry is stuck in what management themselves have described as one of the longest and deepest downturns in decades.
Okay, moving on to the second pillar of their thesis.
Yeah.
And this is maybe the most mind-bending piece of this puzzle. Financial fortitude. This is where the story gets really counterintuitive because the headline accounting loss they reported in Q3 2025 was massive, yet their cash generation was somehow equally massive. We are seeing a historic divergence between accounting reality and cash reality.
That disconnect defines the entire investment case for LYB right now, and it's what their management team is desperately trying to highlight to the market. The headlines were terrible and they caused a sell-off.
I remember that.
LYB reported a net loss of $890 million in Q3 2025. This loss, however, was primarily driven by non-cash charges.
Can you break down those non-cash charges for us? Because $890 million is a number that would terrify most investors.
Of course. It was almost entirely due to $1.2 billion in non-cash asset impairments and restructuring charges.
$1.2 billion. Where did that come from?
Well, it was primarily tied to the formal designation of those distressed European assets as held for sale, which required them to write down the book value to the anticipated much lower sale price. They also took impairments in their Advanced Polymer Solutions segment, the APS segment, due to the sudden and sharp slowdown in the global automotive industry.
But the key here is that these are accounting adjustments.
Exactly. Non-cash charges that do not require an outflow of actual cash this quarter.
So the paper loss was nearly $1 billion, but at the same time, the company was drowning in operating cash flow.
Drowning in it. Despite that nine-figure accounting loss, the company generated an astonishing $983 million in operating cash flow in that very same quarter.
Wow.
This is why management is branding the company the cash conversion machine. They might look terrible on the income statement, but their physical cash position is robust.
And the metric that truly defines this counter-cyclical strategy is the cash conversion rate. How high did they manage to push it?
They achieved a phenomenal 135% operating cash flow to EBITDA conversion rate in Q3 2025. That is just jaw-dropping. It far exceeds their long-term target of 80%.
135%.
And even looking back over the last 12 months, the rate was 99%. This efficiency in converting earnings into usable cash is the key defense mechanism against the downturn.
How practically did they manage to extract that much cash flow, particularly when demand was so soft? I mean, what buttons did management actually push?
It was driven by hyper-aggressive working capital management. They ran assets strictly for cash, not necessarily for maximum volume.
Okay.
This involved two major actions. First, they pushed for significant inventory reductions, liquidating finished goods and raw materials, similar to that LIFO benefit we just discussed, but across the entire operational footprint.
And second?
Second, they optimized accounts payable, carefully managing when they paid their suppliers. This ruthless efficiency released nearly $1 billion in cash in the fourth quarter of 2025 alone.
Let's just pause here and address the conflict that really defines this whole investment thesis. The dividend yield is 12%, and you're saying they generated nearly $1 billion in operating cash flow in one quarter. That sounds fantastic.
It does.
But we also know the dividend payout ratio based on free cash flow has been negative in recent periods.
This is where we have to introduce the necessary skepticism. While the operating cash flow conversion rate is fantastic, the dividend currently costs about $350 million per quarter, or $1.7 billion annually.
A huge number.
And if the free cash flow, which is your operating cash flow minus capital expenditures, is negative, doesn't that mean the cash conversion machine is only working because they're, as the sources suggest, selling the furniture?
Right.
We have to be honest. This dividend is currently being funded by debt and asset liquidation, not sustainably covered by operational earnings alone.
That distinction is so critical. The high operating cash conversion is buying them time, but it's the manufactured internal liquidity that truly needs to bridge the next 2 years. The centerpiece of this survival effort is the $1.1 billion Cash Improvement Plan, or CIP.
Exactly. The CIP is designed to intentionally manufacture internal liquidity to bridge the market downturn until 2026 or 2027. It's a 2-year buffer plan.
And the targets are?
The targets are $600 million in incremental cash flow in 2025 and at least $1.1 billion by the end of 2026. Management views this internal generation of cash as the absolute foundation of their survival strategy.
Can we break down that $1.1 billion? What are the specific mechanisms they're targeting to hit that enormous number?
The initial $600 million target for 2025 was structured in 3 equal parts. Roughly $200 million from working capital reductions, like the inventory management we just discussed.
Yeah.
$200 million from fixed cost cuts, and $200 million from CapEx deferrals. The $1.1 billion target by 2026 represents the full realization of these cost savings and efficiencies across the entire global organization.
And on the fixed cost cuts, management says they've already achieved $150 million year-to-date in 2025. Fixed cost reductions are painful. What does that actually entail? Are we talking about layoffs and closing offices?
We are talking about deep, permanent changes. Organizational efficiencies, significant cuts to professional services and consulting fees, and aggressive renegotiation of long-term utility and maintenance contracts. Fixed costs are notoriously hard to cut because they represent the basic structure of the organization.
So hitting that number is a big deal.
Achieving $150 million in less than a year demonstrates a radical level of internal restructuring designed to make the company permanently leaner, not just temporarily cheaper.
This cost discipline leads us to the most extreme measure, capital discipline. They are essentially putting growth on hold to protect the balance sheet, which meant deferring some major investments.
That's right. They are prioritizing liquidity and, crucially, maintaining their investment-grade rating above all else. They drastically reduced their 2026 CapEx guidance to just $1.2 billion.
$1.2 billion. What would that normally be?
Historically, a company like LYB would be spending closer to $2 billion, so this is a major reduction. The core maintenance CapEx has been stripped down to only what is absolutely necessary, about $1.0 to $1.1 billion for safe and reliable operations.
And the most symbolic deferrals were those growth projects, specifically the Flex 2 propylene project, and critically, the construction of the MoReTec 2 recycling facility in Houston.
By deferring MoReTec 2, they demonstrated a refusal to commit growth capital without absolute certainty of return, even to their celebrated future-facing technology.
It's a clear signal.
They are saying, we know this is our future, but if funding it today means jeopardizing our credit rating or the dividend, the growth can wait.
This disciplined approach brings us to the most quantifiable piece of their defensive strategy, the 2026 bridge. Management isn't just relying on the market cycle to spontaneously turn. They're projecting a massive sequential improvement in 2026 based purely on avoiding the bad luck and one-off internal catastrophes that plagued 2025. And here's where it gets really interesting.
This is the $400 million question, quite literally. The CFO, Agustin Izquierdo, he projected a significant $400 million to $450 million sequential EBITDA improvement in 2026.
Okay.
This is the quantifiable rationale for believing they can maintain financial stability even if the broader petrochemical cycle remains stubbornly weak.
So they are saying even if the average selling price of our product doesn't increase, we will still look nearly $500 million better. How solid is that math? What are the key factors driving that projected benefit?
The math is based on normalizing operations and avoiding three key large-scale one-off negative events from 2025. The largest single factor was the non-recurrence of the massive Channelview turnaround.
Right, the big maintenance shutdown.
That heavy maintenance, which is necessary every few years, cost the company about $200 million in lost production and direct costs in 2025.
That's half the bridge right there, just avoiding a planned internal event. What else contributed to 2025 being an abnormally bad year?
They had massive supply chain and market chaos, particularly recovery from the volatile oxyfuels market. This was caused by unexpected industry outages and large-scale supply disruptions.
I remember reading about that. The Dangote refinery startup.
Exactly. The highly complex and delayed situation around the startup of the Dangote refinery in Nigeria, which temporarily skewed global product pricing and logistics for months. On top of that, they also suffered about $60 million in weather impacts, like the Q1 2025 winter storm.
So by simply returning to a statistically normal operational environment, avoiding these unusual high-cost disruptions, they automatically gain back $400 million to $450 million in EBITDA.
That's the math.
That's a fascinating narrative. Management's pitch is essentially, we will look significantly better in 2026, even if the world chemical market doesn't magically fix itself, purely because 2025 was uniquely dysfunctional due to our own maintenance and our competitors' chaos.
It creates a powerful financial floor. If you add that $400 to $450 million operational bridge to the $1.1 billion from the cash improvement plan, they are arguing they have manufactured enough internal recovery to survive the external downturn without touching the dividend.
They're manufacturing the recovery internally to withstand the external flood.
That's the perfect way to put it.
Now, let's pivot away from survival and talk about their long-term moat. The operational pivot around MoReTec and the circular future. While they're shrinking the legacy business, they're clearly betting heavily on this proprietary technology for growth and margin expansion starting in 2027.
MoReTec stands for Advanced Chemical Recycling, and it is the central pillar of their long-term growth strategy within the Circular and Low-Carbon Solutions, or CLCS, business.
This is where they move from being a commodity producer to a solutions provider.
Precisamente. The technology is proprietary, and it converts notoriously difficult-to-recycle plastic waste. We're talking things like mixed plastics, multi-layered food packaging, industrial films that traditional mechanical recyclers just cannot handle.
The stuff that usually just goes to a landfill.
The stuff that goes to a landfill. And it converts it into high-quality pyrolysis oil and gas. This pyrolysis oil then serves as high-purity feedstock for new virgin-quality polymers.
And this is not just an environmental obligation. This is a high-margin business that actually generates premium returns immediately.
Absolutely. The economics are what matter here. The resulting pyrolysis oil commands a premium of approximately $500 per ton over virgin plastics feedstock.
$500 a ton. Why so high?
It's due to regulatory pressure and, more powerfully, the enormous demand from major consumer brand owners globally, think Coca-Cola, Unilever, Nestlé, who have aggressive public commitments and often legal requirements to include a minimum percentage of sustainable or recycled content in their packaging.
And they're willing to pay that premium to guarantee their supply.
They are. So the CLCS business, anchored by MoReTec, is central to LYB's long-term ambition, which is targeting $1 billion in incremental EBITDA by 2030. That is a massive growth target for a company currently fighting for survival.
It is, and the tension between that long-term vision and the current capital reality is perfectly illustrated by their disciplined growth model. They're building MoReTec 1, the first commercial-scale facility in Wesseling, Germany.
Right. And that plant is aiming to ramp up in 2027 and target about 25 to 30 million in annual EBITDA. Its success is the absolute prerequisite for the entire $1 billion long-term plan.
But despite that massive long-term potential, we saw management defer the construction of the second facility, MoReTec 2, in Houston. This just perfectly captures the priority. Cash today, overgrowth tomorrow.
It's the definition of extreme capital discipline. They're not speculating on this growth, which is a key differentiator from some competitors. They set 3 very strict, quantifiable conditions before committing capital to the Houston expansion MoReTec 2.
What are those 3 non-negotiables?
First, they must have secured off-take agreements in place. This means committed buyers, contracts signed, guaranteeing the purchase of the recycled feedstock before they even pour the concrete for the plant.
No, if you build it, they will come.
None of that. Second, and this is crucial, the MoReTec 1 facility in Germany must prove economics before scaling. They need commercial validation, clear profitability metrics, and stable operations before replicating the expensive process in Houston.
And
third, they require improved market stability for recycled feedstock, meaning clear regulatory frameworks and predictable pricing visibility.
that is the franchise model applied to advanced chemistry. They won't open the second massive Houston location until the first German pilot proves profitable and they have customers signed up for guaranteed meal plans. This conservative approach is necessary to limit short-term cash burn, but I have to ask, at what cost to their long-term competitive position?
That is the ultimate trade-off, and one that is highly debated among analysts. By being so disciplined, they maintain their balance sheet health, but they potentially give up valuable first-mover advantage and market share in the premium circular economy space.
Right, to competitors who might be willing to take on more debt today to dominate that $500 a ton premium tomorrow. Before we move on to the risks, we should probably mention the Advanced Polymer Solutions segment, the APS segment, which acts as a crucial offset to the deep, painful cyclicality of their commodity chemicals.
Yes. The APS segment is their high-margin insurance policy. Although it took that non-cash impairment hit in Q3 due to the automotive sector slowdown, this segment is highly specialized. It deals in high-margin products like advanced polypropylene compounds and engineered plastics.
This includes the famous Purell healthcare brand polymers.
Right, this is the one.
Why is this segment considered recession-resistant, or at least less cyclical?
Because of the end markets. These are highly specialized materials used in critical applications like medical devices, aerospace components, and specialized packaging that require really stringent quality control.
So things people still need no matter what.
Exactly. People don't stop needing medical supplies or specialized plastics just because the economy slows down. This specialized high-margin niche provides a necessary, stable offset to the huge, unpredictable cyclical swings seen in their commodity olefins and polyolefins segments.
Okay, we spent a lot of time on what LYB is doing right internally, sandbagging the house and selling the furniture. Now, we have to look at the external risk factors, because this is where the bear case, the argument that this is purely a value trap, really gains undeniable traction. Let's address the elephant in the global marketplace, the China factor and the threat of permanent structural deterioration.
This is the fundamental conflict that pits LYB's internal efficiency against these huge global structural forces. The bullish view assumes we're in a normal cyclical trough, and capacity rationalization will eventually fix it.
And the bearish view.
The bearish view, which our sources strongly emphasize, is that this is not a cyclical downturn at all, but an evolutionary structural shift in the petrochemical industry caused by massive, subsidized global capacity.
And China is the engine driving that structural shift, just overwhelming the market with supply.
Absolutely. Global supply is expected to structurally outgrow demand for several years, primarily due to China's aggressive, nationally supported expansion into chemical production. The scale is staggering. Analysts project an addition of 22.87 million tons of new propylene capacity additions expected by 2030.
22 million tons.
It's enough new supply to fundamentally change global pricing dynamics permanently.
But the problem isn't just the sheer volume of capacity they're adding, is it? It's the operational context of how these Chinese plants are actually run.
That's the most damaging part of the bear thesis. Many Chinese state-owned or state-influenced plants are often running at what analysts call technical minimums for non-economic reasons.
So they're not running to maximize profit.
Not at all. They're running to safeguard employment and maintain regional industrial stability, often completely ignoring high input costs.
What does running at a technical minimum actually mean for a company like LYB?
It means that the market doesn't get to clear capacity the way it usually does in a downturn. In a normal cycle, the high-cost, inefficient producers shut down or go bankrupt, and that allows prices to recover.
But that's not happening here.
When plants run at technical minimums for non-economic reasons, they artificially inject structural oversupply into the global system. This permanently depresses global pricing, regardless of whether current demand justifies it. This makes the downturn a structural rather than merely a cyclical problem.
So even if LYB is the most efficient U.S. producer, they can't escape that global price suppression, which inevitably pulls down their realized sales prices. This brings us back to their core competitive moat, If the market is structurally broken, their feedstock advantage must be under threat.
It is under threat, and this is the second major pillar of the bear case, the eroding cost moat. We discussed the oil-to-gas ratio being their core advantage, allowing them to use cheap ethane. Unfortunately, this ratio is compressing unfavorably for LYB.
How bad is it?
It has fallen precipitously from historical highs around 50x down toward 15x.
Why is that compression so dangerous to the LYB model?
Because it squeezes their margins from both ends. The compression is caused by two factors. Rising ethane prices here in the U.S., linked to tightening natural gas supply, and softer global crude oil prices.
Which lowers the cost of the competing naphtha feedstock used by Asian and European producers.
Exactly. So if crude oil prices fall, their competitors' cost structure improves. And if U.S. ethane prices rise, LYB's cost structure worsens. That narrows the gap.
And that 30 to 40% advantage starts to shrink.
Right. While LYD is still advantaged at a 15x ratio, their break-evens are significantly lower than that. The compression is eroding the crucial margin gap they rely on. If that trend continues, their financial superiority disappears, and their shrink-to-strength model, built on that geographic arbitrage, becomes far less effective at generating the cash flow needed to service the dividend.
Which brings us to the ultimate stress test for the company, their balance sheet, and the pressure caused by that massive high-stakes dividend. Let's talk about the leverage in the vulnerable dividend. The fact that the yield is currently 12 to 13% is the clearest market signal of financial distress.
It is the market screaming that the dividend is unsustainable. The financial strain is palpable in their debt metrics. Net debt to EBITDA, excluding identified items, has risen significantly to 3.6x as of Q3 2025.
3.6.
That ratio is dangerously close to threatening the company's long-standing investment-grade rating, which management has repeatedly stressed they must protect above all else, even above the dividend.
And given that the annual dividend payout is $1.7 billion and operational earnings are impaired, the math suggests they are in deep water funding that payout.
They are. We established that the dividend is currently being funded by negative free cash flow and asset liquidation, the cash releases from the Houston closure, and critically, the anticipated proceeds and cost avoidance from the European asset sale.
So if that European deal fails?
If that European deal fails to close, or if the structural market downturn extends past 2026, the debt ratio will spike further.
And if the debt ratio spikes, what is the logical action management must take to protect the credit rating?
A dividend recalibration.
Which is a corporate euphemism for a cut.
A cut. Analysts are unified on this point. Management has explicitly prioritized the investment-grade rating because protecting their access to cheap capital is essential for long-term survival. If they are forced to choose, the dividend is the sacrificial lamb.
And this inherent risk is highlighted by management's proactive steps. They even amended their revolving credit agreement in September 2025.
That amendment is the ultimate safety net they bought themselves. They increased the maximum leverage ratio covenant in that agreement to 4.5x through 2027.
Why would a healthy company need to increase its borrowing limit on its covenants?
They wouldn't. It's because they know the debt ratio is flirting with the limit, and they need breathing room to execute the asset sales without accidentally triggering a covenant breach. It just underlines the sheer risk they are taking by maintaining the dividend through this downturn.
This brings us to the final verdict. We need to synthesize this entire complex strategy using that powerful analogy provided in our sources, the flood zone analogy. It just perfectly summarizes this high-stakes bet.
It's the perfect unifying metaphor. LyondellBasell is like a homeowner in a flood zone trying to survive a catastrophic multi-year storm.
Okay.
They are furiously sandbagging the house, that is the $1.1 billion cash improvement plan, cutting fixed costs, reducing working capital, and deferring non-essential capex to keep water out of the living room.
They are also selling the furniture in the attic.
Yeah.
That's the divestiture of the Houston refinery and the 4 high-cost European assets. They're liquidating long-term holdings to free up necessary cash.
And this cash is being used to pay the mortgage, the massive 12% dividend. The core strategy is a high-stakes bet that the floodwaters, the structural market downturn caused by persistent global overcapacity and margin pressure, will recede by 2026, allowing them to resurface as a permanently leaner, more efficient company.
So for you, the listener, considering this stock, the decision really boils down to execution risk versus structural market risk. What is the final choice? Is the 12% yield truly a generational opportunity or a carefully disguised value trap?
Let's review the two sides. The bull case views this as a generational opportunity to capture a massive dividend yield from a blue chip name. This thesis relies entirely on execution.
So everything has to go right.
Everything. If the $300 million European fixed cost reduction closes in the first half of 2026, if that $450 million sequential EBITDA bridge materializes purely from operational normalization, and if the global capacity rationalization, where analysts estimate up to 21 million tons of competitor closures, could happen by 2028, if that actually tightens the supply-demand balance,
Then what happens?
then LYB emerges as a highly focused, low-cost leader and the dividend holds. The stock re-rates massively.
And the bear case, conversely, views this as a calculated value trap built on overly optimistic assumptions.
And this thesis relies on structural factors. If the Chinese oversupply persists, keeping prices artificially depressed, if the oil-to-gas cost moat continues to erode, and crucially, if that difficult European deal fails to close, the elevated leverage of 3.6x forces management to act.
They have to cut the dividend.
They will have no choice but to cut the dividend to protect their investment-grade credit rating, likely leading to a rapid stock price decline.
So what does this all mean?
It means you are not buying a stable income stock. You are buying a complex, high-wire corporate turnaround story with a very high barrier to success, but one that offers a guaranteed massive cash payout while you wait for the outcome.
And the next 12 months are critical.
The next 12 months, specifically focusing on the closing of the European asset sale and the realization of that $400 million operational bridge, will determine if management is vindicated or if the market sentiment proves lethally accurate.
That is an exceptional summary of a truly high-stakes corporate transformation. Before we wrap up, let's look at one final provocative thought for you to explore on your own that builds on the fundamental trade-off we just discussed. Short-term cash versus long-term growth.
We noted that LYB prioritized immediate cash and balance sheet integrity over future growth, which led them to defer the construction of the MoReTec 2 recycling facility in Houston.
Right.
And while this showcases extreme capital discipline, it does raise a significant strategic dilemma. By strictly adhering to those three conditions, offtake agreements, proven economics in Germany, and market stability, is LYB slowing its own progress toward that massive $1 billion incremental EBITDA target by 2030?
That is the essential conflict. How quickly can a company pivot away from commodity chemicals and dominate the premium circular economy model if it is unwilling to commit growth capital during the exact market downturn when its weaker commodity competitors are struggling? By hitting the brakes on MoReTec 2, are they potentially losing the opportunity to capture critical early market share in the premium segment that commands that crucial $500 per ton premium? Are they sacrificing future dominance for current survival?
It's the ultimate strategic calculation in a cycle-driven business, and the answer to that will not be known for several years.
Thank you for sharing your sources and letting us dive deep into LyondellBasell's aggressive transformation plan. We hope this deep dive helps you define the risk and understand the potential generational reward of this extraordinary self-help bet. Until next time, keep digging.